So very good evening to everybody and our apologies for the delay. So let's start with the market outlook first, okay? And we just want to, last few months we were saying what we said in January, how it played out, what we said in April, how it played out now, okay? So this has been our thesis. Right from January, we are talking about a fragile 2026. The geopolitical volatility remain elevated, and how you talk about looking at the inflation and yields moving up. We also highlighted very specifically right from February that crude prices will spike April onwards. Okay, and we talked right February onwards. And in the last month also we talked about that this cycle has peaked out at 120 and now where we are heading, and we can see the massive corrections happening. This is something similar. I just want to put a perspective how exactly the track record has been played out, what we are able to visualize through predictive analytics, and how well it has been implemented. So let's start with the precious metal theme. Beginning 2026, we highlighted that precious metal cycle is peaking out and nearly 5,500 USD. On the COMEX, we sold our gold into a multi-asset fund, and we talked about the range will be around 52 to 5,500, and lower side should be 4,400 to 3,800. Now we have seen we are closer to 3,800 mark. It is much below 4,000 marginally plus minus here and there is there, and something similar. We exited around 114 levels or so. Now it's closer to 16 mark or so. So if you really look at, we are approaching all those area what we talked about in January. Now, obviously, we proved down. We have recently started adding precious metal in our portfolio, though our medium term outlook is still cautious. And obviously, long term, we always talk about this is the core portfolio thesis. One should have certain amount of precious metal in their portfolio. But very important to understand how timing plays a very important role. And this is one of the reason in the one of the presentation on multi-asset funds, I'll talk about how best we can capitalize this opportunity, which is knocking our doors now. Now let's talk about few minutes on crude. Okay, as I said in the beginning, uh, right from February, we said crude will spike, and when closer to 120 marks on multiple channels, also I talked about, we'll see crude coming below $70, and we are there. Okay. Now it has happened even much earlier than what we have thought of. Okay. But this is what how when you were able to see with the help of market implied analytics, when the whole world was talking about 150 and 200, we said that is approaching 70. Obviously, it has a lot more ramification for India as a market, and which is largely crude dependent. So obviously, if we believe crude has peaked out and started corrected, it is the great news for economy from a rupee perspective, using INR pair perspective, as well as macro perspective. So one important development which is in our favor. Now, obviously, it is closer to below 70 marks, and we have talked about 77 to 60 levels or so. I don't see NYMEX crude falling below 60 mark. So maybe closer to 63, 66 level, we will be buyer in crude. And that's what we have done. We've added in our multi-asset fund and the active asset allocator fund on the SIF fund on the crude. This is the first time we are taking a trade position on the crude also, because we believe the downside is limited from the current level and upside cannot be very meaningful, but it can give you a spike. So as unless we start building position and trade in this thing, it is all remain as an academic exercise only. And this is something which we think we are able to spot the macro picture better than the market participant. So this is the one important thesis which I want to highlight. Now let's talk about the currency perspective. The most important point was the beginning of the year. We said that dollar is the biggest risk, the dollar index, which is the biggest risk, which is against these seven countries. And this is the perceived risk of 2026 from 96 to closer to 102 mark, which has seen. It has not done anything meaningful, but this is the one area of risk which we highlighted has played well, not up to that extent in terms of spike which we were expecting, but this itself is a important data point to keep back of the mind that from a short term and medium term perspective, still dollar index has potential to appreciate. So that is a purely from a risk assessment point of view, we have to keep in back of the mind. Now coming to the Indian equities. Now, obviously, beginning April, 1st April, when we released our fact sheet and the monthly call, we have talked about that worst is behind us. And we said that this is the time not to get capitulated, it's the time to capitalize the opportunity. And we said how small cap and mid caps, which we were very negative for nearly 2 years now, we are early to spot in July 2024 itself that something has changed for India. The macro picture was started deteriorating because our multi high frequency analytics were showcasing that, and something which got reversed in the end of March. And that's the time we talked about how USD INR pair could be peaking out, how the trade related challenges which we have seen is settling down, and we are seeing more free trade agreements getting signed. And we are also clear in our head this battle is slightly settling down. I'm not saying it is over. And we always said that this decade, the geopolitical volatility will remain high, and we have to navigate that instead of getting too depressed about what is happening globally. I think every crisis leads to an opportunity, and this recent war also have a lot of positive effects also in India in terms of data center story or aviation thing, or in terms of looking at the way we look at our energy or EV or the other aspect in terms of storage facility. Lot many steps. Obviously, government is also looking into it very clearly, which will help us in fighting a next battle lesson when it happens. So this is another area we are talking about signs of exhaustion in the FII selling, which we have seen FPI front. FDI investment has started picking up. Okay, so if I have to say it, in July 2010, 24, we talked about that high frequency macro picture was deteriorating. I can say with good amount of confidence is improving, and best of the global firms have downgraded India. Best of the people are very negative. And this is one important thing we talked about with beginning. You have to remove the negativity that that is there in the subconscious mind of the most of the participant. And that's the reason when last 2 3 months rally happened from April, May, and June sort of thing. People have missed out big time because people are very extremely bearish on the market and hence not able to capitalize. Where we did the exactly opposite, because again it's not a contra call, it's a data driven call. Now this is the thesis which we have been talking about. Now what is important for us to understand, obviously uh, we have seen a decisive move. Now going forward also, I think this year, if I have to say second half of 2026, it's not about indices. It is going to be all about stocks, how well you can identify stocks. And certain sectors is important, but I think within the sector, how well you are able to identify the stock with the help of money flow analytics or any other tools which we use, it is very important. Now 2 3 things which I want to highlight from a larger perspective, how India will be beneficiary, because in the business of returns, when we always talk about absolute return and relative returns. So, from a absolute perspective, we may not do anything meaningful, as I said, because I said in the beginning that you don't have to look at the indices, but stock specific you will see. But look at from a relative opportunity point of view. Last month call we talked about that Korea and Taiwan is showing signs of euphoric, and particularly Korean market, which is we think could be a medium term top is in place. So is the case with Taiwan, and I think by mid of this month itself, even US market has potential to peak out. So what is important to understand, if global markets and emerging markets suffers, how come India can be beneficiary? Because India has been underperforming for a while now. It's been nearly 8 to 12 quarters we have been underperforming. So if that phenomena plays out, which we expect, then some money will definitely shift towards India. And we are seeing baby step of that move already getting implemented. And I think we have seen many FIs are coming back, not in the with the bank sort of thing, but they have started nibbling in the market. So I expect, if we are in the right pockets and able to identify right stocks, I think second half will also can be meaningfully important for us, because we think stock specific approach will play out. Now, obviously, beginning 2000 April 2026, we talked about this. Going forward is all about underowned, neglected, beaten down. We have seen how one by one sector which has been neglected for a while, or stock which have underperformed, are coming back gradually. And the star of last 2 or 3 years actually started struggling. Okay, they have not collapsed, but they have started struggling. So I think it's an opportunity which we have to look at the under ownership aspect. Not only the FI's ownership, we are worried about the domestic mutual fund and domestic insurance ownership is equally important, because that is also area where we see discomfort whenever, and the classic example has been how the banking underperform, how the IT underperform, where people have large exposure in both the sectors. Both the put together, a lot of people have 30 to 40 or 45% exposure also in these two sectors. And that was one of the reasons that lot many funds have actually underperformed. And this is the one thesis which I've been highlighting this year is all about SMIT opportunity. If you're able to identify right SMIT stocks, I think that is the area, the small and mid category, which I'm talking about. So this is another thesis which we are looking at. If I have to really conclude from the market before I move to the next slide, uh, very constructive from a medium term perspective. But the way market has rallied, it may not be the case on immediate basis. Market is now in a consolidation phase. The stock specific approach will be important for us. And as and when global market correct sharply with a lag effect, India will be a big beneficiary of that. And given where we are in terms of commodities prices also, and particularly on the energy side, we should be beneficiary. Now let's spend few minutes. I want to talk about our revolutionary framework. We talk about the BLRT framework, which have been implemented somewhere in the mid of 2020. Post COVID, we implemented this thesis, which we have been running for a while. And I just want to give you perspective, because I always say equity investment is largely from a medium to long term perspective. 6 months, 2 years may not give you perspective. If you have 5 to 10 years horizon, if I to say any cycle with 6 year cycle, if you invest, even if you came at the peak of the cycle, you will still going to make money, provided you remain invested. And this is what exactly we are trying to showcase. We have been 6 years, it has been built. So we always talk about it's a continuously learning process. We always said this revolutionary framework has been built from a lot of mistakes which we have made in the past. It's a great learning. It's the ever evolving process which we're doing, and how it has delivered. This is something I just want to talk for a few minutes. Uh, when we started our own asset management business on the entry on the mutual fund side, being a research background in the past, we were very vocal that era of buy and hold strategy has passed. This is the thesis where I have also grown, so that buy and hold is the model. From longer term perspective, it will work. Yes, when you are in the early stages of any market, when I say in the infancy stages or the growth phase, now Indian market is no more immaturity phase. Okay, if you don't call it as a developed market, but India is no more emerging market. Okay, it is. I think it's a reasonably evolved market, and this is the way we define. And if you are in an evolved market scenario, this buy and hold thesis is not going to work globally. It hasn't. This is the important thesis I want to talk about. So we brought the thesis of dynamic style of money management. We were the first asset management company or the mutual fund. We introduced the dynamic style of money management when we say we live in a dynamic world, and hence our money management cannot be very static, and that has really played out well. So let's look at what is the conclusion and the output which we talked about, what has delivered. First, obviously, it has delivered massive performance, which I'm going to talk about, which has led to significantly investor association of more than 1 crore investors, 34 schemes, more than 1 crore of asset under money management or money under management, or typically AUM, what people call it. So if you look at April 2020, when we implemented this framework, we were 135 crores. And today, 6 years later, we're 1 lakh crore. It gives you a fairly good amount of comfort that something went right in terms of framework, and how this valuation analytics, liquidity analytics, risk appetite, and timing analytics has played a role. And the most important aspect is the performance. Let's spend a few minutes in this presentation. Important to understand, we have only considered only those schemes of quant which has more than 3 years of history. Many schemes have 15 and 20 years of the history also, because we acquired a firm, but we launched many funds in last 5 years or so. So only more than 3 years fund has been captured. So it'll give you a fairly good perspective. Now, if you really look at performance of 10 years perspective, our multiple schemes, if you see except one mid cap. All the schemes which is qualified, they're actually in quartile one performance in 10 years perspective. And some of them are actually number one position also. Okay. Majority of them qualify for the top ranking also. But since we are talking about quarterly disclosure perspective or in terms of analysis, really helps us how the fund has performed, how the benchmark has performed. And if you look at, see the outperformance versus the benchmark of 11%, 7%, and if you really look at a CAGR return closer to 20%, it's a very sizable numbers returns which we have given, 19, 21, 21, or 17 or 18 and a half. It's a substantially good number to talk about this sort of return. Even you say anything between 19 and 21, an average of 20%, it's a remarkable journey for us. And this speaks about how beautifully the VLRT framework has been implemented and it is showing results. Now, if you even talk about our own 5 year performance, okay, from 10 years, if you come to 5 years performance, you see multiple schemes are in quartile one. If you look at the 70% schemes are in quartile one, and so is the case, few of them are in quartile two and three also, which what is, and we have given a very transparent manner the entire disclosure aspect, how it has played out, okay, the 5 years track record versus benchmark, how sort of outperformance which is there in terms of the 5 years category also, that is important. Now, even you look at 3 years perspective, that also give you a fairly good perspective that even 70% or 75% of our schemes are in quartile one, again from a 3 years perspective. A massive outperformance there. If you see last 3 years, right from 18% to 27 odd percent returns are there, depending on the which schemes category you're looking at. Again, a great performance. Even last 1 year, which has been very challenging for the industry, if you really look at 85% of our schemes are actually in top quartile one, and frankly speaking, majority of the schemes is actually ranked one. Okay, since we are looking more from a quarterly perspective, you look at the what sort of returns we have given in last 1 year, 2% to 18 to 19% returns we have given, and what sort of outperformance in multi-asset has given nearly 22% odd returns. So we're talking about sizable outperformance even 1 year journey. So if you really compare 1 year, 3 years, 5 years, 10 years journey, it's a very meaningful performance which we are talking about. Okay, now let's come, just give me 1 second. So please set down the sorry about it. So when we're talking about this 4 dimension in motion, we have explained me how timing analytics is a function of valuation analytics, liquidity analytics, risk appetite, and how beautifully it has played out from a returns perspective. Now, this is another thesis we always say with a lot of pride. When we talk about timing, I always say timing is a risk mitigation tool for us. A lot of people think, oh, timing is a trading angle. No, timing is everything and everything else is conjecture. If you can time it, we always talk about right time, right place. It's very important from a risk perspective. So timing analytics is a very important risk mitigation framework which we have built over a period of time, and something which we are really proud of, that we are able to change the mindset of people. When people look into, yes, time in the market is important. Okay, what is important is that if you can crack this inflection point thesis, okay, like look at the classic example, technology. We downgrade tech in September 2021. Now people have vomited. When I say vomiting, it's about the classic capitulation process. Everybody has tried to bottom fish in last 2 years, 6 months, 1 quarter, and is one way falling. And you are the one fund house with nearly zilch exposure in the space. Now, obviously, we don't mimic the indices. That's a thesis that I'll cover in the next slide. But now we are even looking at some of these neglected territory stocks. So if technology is now coming into that hated, neglected zone, if we are able to identify, and that gives you an edge. If you can time it better, you protect your downside. If you time it better in terms of selling, you protect the downfall also, which you can see. So you have booked the profit. Now it's very important to understand that this as a house, Majority of the people look at the bottoms up approach, stock specific approach. We are traditionally very macro house. So macro to micro we come. We try to understand global risk appetite, global liquidity, India risk appetite, India liquidity. And you have to be clear in the business of risk, you have to be ahead of the curve. You cannot be late in identifying, otherwise, doing a postmortem analysis is very easy. How it leads to a money flow analytics, how the VLR framework gets into build, and finally leads to timing on the portfolio. Now, important philosophy. Okay, uh, we keep on hearing in the market, oh, I'm a value investor, I'm a techie investor, I'm a growth oriented investor, I'm a growth at any price. Everybody has tried to showcase some amount of specialization, or everybody tried to showcase the particular philosophy. And people talk about the philosophy. This is what it compounds, where we have a very different thesis. We very clear that any great investment philosophy doesn't compound, only returns to. So when we talk about our approach, we are very clear we are not benchmark centric. We don't mimic the indices. We are outcome driven. We are pure opportunity. We are not looking about style or any sort of rule based or passive style or convention. We we run this from in a very active, absolute, and unconstrained style. It's the entire thesis that we have to be unconstrained fund house. We are style agnostic, market cap agnostic, thesis agnostic, very dynamic, very adaptive, very active, and pure opportunity driven thing, provided we get superior risk adjusted opportunity. That's what we are trying to identify. It's very important to quantify. Now I'll give you a very important thesis. Okay. The market changes, the regime shift and opportunity have to migrate. This is a very important thesis where a lot of people have rigidity. People don't want to change. Okay. Now, we as a house of quant, we always talk about adaptive asset allocation. And you have to adapt the prevailing macro environment and how exactly playing out. And then you can capitalize on that opportunity. This is something important for us to explain you. And most important thesis we have seen out in India and globally, majority of the people actually try to follow the benchmark. They mimic the benchmark. 70-80% time you give similar weightage to the benchmark. Only 10-20% weightage where you are able to generate alpha and outperform. So the entire thesis is that if your 80% is index portfolio is similar to the index, you have only 20% flexibility left. So obviously, neither you are going to outperform decisively, nor you are going to underperform the index decisively. This has been the trend which I think we have seen post 2008 crisis followed globally, where the first time we saw the liquidity crisis coming in, and people didn't know how to react. And that's the reason a lot of people started parking in terms of just mimicking the indices from the safety perspective. And market was even more smarter. When I say market, the participants, when they realized that the money managers are charging the active money management fees and they are offering quasi passive, they move towards passive product in a way. And that's the reason we are saying from 2012, the passive growth globally was very meaningful. Now, if you look at in last 2 years, particularly, or 8 to 12 quarters, globally, who has made money? Two stocks in Taiwan, six stocks in Korea, some 7, 8 stocks in China, 7, 8 stocks are in US. So if anybody is running a skewed portfolio, has made tons of money. People who have followed this broader thesis of hugging or mimicking the indices have actually underperformed. Not only in India, globally they have underperformed. And this is the reason uh, going forward also, when we are in a complex geopolitical world, the active money management is the only answer. Okay. And this is the reason we at Quant follow. We don't follow passive investment strategy. We don't offer quasi passive strategy. We don't do index again. We clearly are pure active money manager. When we charge our fees for active money management, we don't offer quasi passive strategy. Very clear differentiation we're talking about. How 2 years has been changed. The whole world is looking into a different perspective, this passive style of approach, which majority of the global fund houses, including India money managers, are copying. That era has passed. And this is the reason how few stock performance was so meaningful. That's the reason we are saying that few stocks have changed the world today. So that's the one important philosophy we want to talk about, our money management style. A very data-driven, discretionary active investing approach, because data is God. We always say data is God. Okay. And this is very important thesis for us. And that's the reason these outcomes are there. Now let's understand even the performance aspect, which we broadly explain you. Now, if I have to run through our multiple scheme performance, 1 year, 3 years, 5 years on the quant flexi side, this is a very nice slide where we have tried to showcase what was the industry average, what is the maximum, what is the minimum, what is the benchmark return. One slide we have tried to cover. So let's say if you look at the uppermost slide out here, you see in 1 year where we stand. We have given 13.1% return. Highest return is also 13.1. Okay. 3 years, what we have delivered, 22.8. Highest return was 22.8 for the category. Average was 13.90. Benchmark was 15. So we have decisively beaten the benchmark in 1, 3, 5, and 10 years. Look at 10 years, maximum return was 21 and we have given 21% return. In 5 year maximum return 18.5, we have given 18.3. It's give you fairly good perspective in terms of our own standing within the entire landscape of mutual fund, how we have performed. This is the returns what we have generated. If you really look at 3, 5, 10 years, average return is 20% CAGR. It's a very sizable return and it's a reasonably good journey, which we are very proud of thing. And this is not the one fund we are trying to showcase. Look at, we are trying to showcase all the fund who have completed 3 years track record. So it's not like we are only showcasing the best, we are showcasing everything. Look at our multi-asset fund, how it has performed in last 1 year. In fact, it's a very interesting product, multi-asset. Okay, this is one of the scheme has actually outperformed the benchmark also. Okay, the small cap, mid cap, large cap, even beaten the benchmark decisively. And not only the own category benchmark, even the other category is done very well. So if you really look at 3 years CAGR of 26%, 5 years CAGR of 21.5, 10 years CAGR of 19.25, it's a sizable returns which multi-asset fund and given, and very important, the risk profiling of these funds are significantly lower than the equity. So if you really look at the risk adjusted returns, they're even superior. So this is also very interesting data, how we look at the markets now. Similarly, where we stand in terms of small cap, where we stand in terms of techs. I'm not covering each and everything, but returns are meaningful out there also. But just trying to give you the whole perspective where our large and mid caps are there. Okay, how aggressive hybrid fund has done. Okay, which is another very interesting data, how we have performed the hybrid category, or how the hybrid performance is actually very interesting. Now, in a focus fund, though we run our focus fund on the large cap side, this comparison is for all categories, but it to give you a fair good perspective. However, the thematic fund infra has done, okay, reasonably good return, 3, 5 year, 23, 22, 27, 21.7, a reasonably large number. This is how our mid cap has done, which has not done that great. When this is what we number we have tried to showcase, how the multi cap has done, how the ESG, this is the new category, very limited funds are there. So very interesting. This journey is also closer to 22% in ESG journey is also given in 3 and 5 years perspective. Interesting product, how we run quantamental, a quant style of fund management where a lot of people run a quant. We talk about quantamental where we bring quant and sentiments together. That's the reason the fund is quantamental. It has completed 5 years now. And if you really look at, it is top quartile, obviously, but is actually leading in every 1 year, 3 years, 5 years. This is actually topmost, is ranked number 1 fund in our entire basket within the quantamental space. So it'll give you a perspective and why it is important. This one fund we manage from a different time horizon, like other equity scheme, we say long term. Here, investor can be long term, but the money management horizon as a money manager is only medium term. So this is the where we are able to cut down even risk also further down, and even hence this product actually deliver good numbers, but the risk adjusted numbers are even far superior. So this is a very interesting. In November 2021, we launched our value fund, and we said that growth phase is over and it's all about value. And you look at the performance With 3 years CAGR is nearly 27%. 1 year also is 18.4, and a year is not. Oh, okay. So it's a very meaningful numbers. Obviously, leader in that category. In that sense, the great returns which have generated. Large cap. I want to spend a minute on this thing. We have seen a very common mistake or trend where a lot many people have moved to a passive thing. Now, in the large cap particularly, we have seen a trend that particularly large cap side, the passive journey or the growth has been very meaningful. But if you really look at this product, it has not completed 5 years. Maybe next year it will be complete that. In 1 year, it has generated 8.2% return. What is the benchmark return? Negative 1.9. So negative, so it means if you have any passive fund in your portfolio, index itself is given 1.9 with a tracking error. Definitely you could have lost to 2.5% average. So 2.5% versus 8.2% positive return. So you're talking about 10 and 0.7% outperformance versus the passive fund. Interesting data. And not only in 1 year, even 3 years. The benchmark returns is interesting, only 11.3%. We have delivered 18.2%, which is the highest in that category. So we are leader in that category in that sense. Look at the massive outperformance you're talking about here. So that gives you a fairly good perspective that you can beat the indices also. So so-called Nifty, we have decisively given a higher returns than the passive funds also, despite the category is quite big. Now, this is some of the thematic funds, business cycle. Again, great history of 21% CAGR in 3 years. Again, a topmost performance in that category. That's very interesting. We launched, a lot of people have balance advantage fund. We call it dynamic asset. We actually dynamically manage. If you really look at the 3 years track record, is a closer to 20% CAGR, which is the highest in that category. So we are the best performing fund in that category in that sense. And the very interesting product, despite you're able to control some amount of your risk, but returns are not compromised. That's the one we think you don't look at for 3 months, 6 months, or 1.5 years. But if you look at the beginning, what we have delivered, it's a very meaningful return. Even in the relatively less equity exposure fund, we're able to deliver closer to 20% mark in 3 years perspective. Now, this is what we always talk about. We're in the business of risk management, returns are byproduct. Now, let's look at our entire thesis. And today I'm just going to cover two most important category for us, a flexi cap and multi-asset. And why we are talking about only two, not others? One very specific thing, given the volatility which we are seeing, and we said that this is the time not to look at the indices, the time to look at stock specific opportunity or sector specific or asset class opportunity. And these two schemes give us highest flexibility. If somebody is looking at equity exposure, then the flexi cap obviously is the biggest category also, gives me maximum flexibility about doing a shift between large to mid to small or vice versa. Similarly, even as a money manager, we have more flexibility in the multi-asset fund. We have not only it's a flexi cap, but it's also about asset allocation, where we can have a flexibility in asset allocation. I said we bought silver yesterday. The last 2-3 days we have bought silver in our portfolio. We sold in January and we are running in a very light manner. So another great advantage that how well you can time it. I'll come to that in appropriate slides. Let's talk about category. Obviously, we all understand is the this category. This is statistical data of AMFI will give you fairly good perspective how important the category is. Now, this is what we have tried to build this fund. Okay, we launched this fund in 8 September 2008. Now, what is unique about flexi cap when we said in the beginning, style agnostic, market cap agnostic, okay, thesis agnostic. We are absolutely no rigidity. Okay, we are not looking at skewness in any manner. We are not running majority of the flexi cap category, which we see in the industry, are more skewed towards large cap. Okay, we still run in a true manner. Like if I give till July 2024, our entire portfolio was skewed towards mid and small. Maybe 84% in the peak we were mid and small. Today, more than 75% is large. But in last 3 months, 4 months, we have increased our exposure in a mid and small in a big way, because that's a call which we made beginning 1st April. This is the time of all about small cap in particular. How well we are able to capitalize on some of the opportunity which we are playing with the help of our own predictive analytics model, how the VLRT framework is working. So it's very interesting data which I shared in the beginning. 1 year, 3 years, 5 years, top quartile fund. Look at what alpha is generated. We can compare where we stand in terms of what is the maximum return category has given, where we stand, and where the category average, and how well we have outperformed the average as well as the benchmark. A fairly good performance to talk about. Now, coming to multi-asset fund. Now, the way we look at why we are talking about multi-asset, we have seen the mistakes a lot of people did. They skewed their portfolio towards gold and silver ETF. I have seen in last 1.5 years at the peak of the cycle, right now, January 2026, when we made this gold and silver top call, I've seen the maximum inflow coming in and around that period. And I'm not against ETFs. What is important to say as a money manager, you should rely on a multi-asset type fund product of any fund house, including quants, because obviously we specialize in a large in a macro perspective. It gives you a huge edge. You don't have to get only in, just landed up in holding these gold and silver ETF at the peak of the cycle, where as a money manager, we prune our exposure. Last 3 days, we have rebuilt some of the exposure, not very aggressively, but we think they're coming closer to our targets. We have started nibbling and we are starting looking opportunity. We are first time we are participating on the commodities also in a big way. So what is important for us to understand? In India, commodities investing was very rare. Last 3 years, gold picked up. Last 1 year, silver picked up. I expect in next 3 years, even copper and other commodities will pick up in a big way as market becomes more and more uh, in terms of liquidity, or the depth will rise, the participation level will going to increase further. So this is the important area which I want to think that people should look at, all conservative investor or even who's looking. When people talk about diversification, unnecessary diversification equity is not great news. Mathematically it looks nice, but in reality it's not. Where you get true diversification through multi-asset fund, and we are a very strong believer in long term. If you ask me which would be my biggest fund in 10 years time, it will be the quant multi-asset fund, because this is something new which is just started. And it's a great track record. If you really look at from our own track record, how 1 year, 3 years, 5 years it has delivered, what sort of returns it has generated. As I said in the beginning of the presentation, is a somebody actually in the market has written about it. This particular scheme has beaten the benchmark indices of small, mid, large and mid, and many other categories. This gives me a confidence with a low risk profiling. If this set uh, multi-asset fund of quants has beaten the small cap index, had beaten the mid cap index with a low risk profile, then you can't have any better product than this. And it is more apt, even from the risk profiling perspective, slightly or more risk averse people. This is a great product, what we want to build. This is the again from a timing perspective. We believe it's a great timing to rebuild your exposure in multi-asset fund, because we are think we are able to capitalize some of the opportunity which is now coming after massive correction in crude and precious metal. So instead of participating through ETF route, we as a money manager do a better job. This is something we do want to highlight out here. How extreme inflection point. I said beginning January we sold, now we are buying. Okay. Now when people have virtually given up, people have lost 50% money, 60% money in these things. So I'm not talking about leverage aspect. Only in the delivery you have taken or ETF you have taken, you have lost sizable money. And that is really makes a lot of difference to a multi-asset fund. I'll just stop it here. Anupam, all for you now, question answers point of view.